If you're watching this video, it means most of you have already watched this interview between two business giants. You've got Alex Hormozi being schooled by Tony Robbins. And most of the people watching this kind of got lost in the therapy session that Tony is giving Alex about how to get out of his own head, find more joy, deliver at a higher level, and not be miserable while he's doing it. But most of us, that does not apply to us at all. And what we're really missing is the gold that Tony delivers, like way at the end of the video, where he is telling us how to live, build wealth, and invest like the 1%. But while everyone was focusing on the emotional state change that Alex was undergoing, they completely missed the real secrets to building wealth that Tony was delivering at the end, when you probably either stopped listening or didn't understand what he was talking about because he hit it in some financial jargon. If you're new here, my name is Emma Powell, and I've spent the last several years investing in commercial real estate and managing an investing fund. I started out as a stay-at-home school mom of 6 kids, and through the techniques that Tony's talking about in this video, I was able to retire my husband early on passive income and myself from my own real estate investing business. So, in the next few minutes, I'm going to reveal the math behind Tony's 10x wealth growth, show you the secret new rules that get you into the room, and explain why you have to stop acting like a consumer and start optimizing your investments and managing your wealth like a business, because it is a business. So, this is the part where most people are getting tripped up because they're listening to Alex trying to find himself. And while this stuff is really important, I just think that it doesn't become important until you're doing the stuff that Tony's saying at the end of the video. So here Alex is talking about what motivates him and what he's looking for. So instead of focusing on this, I'm going to skip ahead to almost the end of the video where most people's eyes started glossing over because it feels kind of like a tangent. But this is where Tony sets up his entire platform for not only building wealth from that small beginner level, but also how he does it as one of the 1%.
What life needs you to do is you live in a free enterprise system.
So everybody's hearing you need to be an owner instead of a renter or just buying useless stuff. But he's talking about ownership at a much higher level.
If I get to be an owner, the whole game changes. Then inflation could be my friend.
So inflation becomes your friend when you own assets that are going up in value. If you own appreciating assets like businesses or real estate, when inflation kicks in and prices go up, your value goes up and your wealth goes up. Inflation is your enemy when you don't own stuff. Prices just go up and you have to pay more. But if you own assets, either as a partner or as an investor of things like businesses and real estate, the value goes up with inflation, and that's when it becomes your friend. And this is the key to ownership right here. Our economy is currently divided between people who don't have a compelling financial future and the owner class who owns things that are going up in value and taking advantage of inflation. If you're the kind of person who is going to use the extra resources that wealth gives you to have that owner mentality, to be able to change affordability issues, tackle income gaps, the hollowing out of the middle class, flattening the K-shaped economy that we have right now. That's the kind of person that I want to help build wealth. And this is the stuff that Tony is talking about as one of his proudest moments elsewhere in the video, where he fed 1 billion meals. And that was one of the things that he takes the most pleasure in doing. So this is the kind of stuff that we want to build wealth for. It's not just to have fancy stuff or to be better than other people, although maybe that's you, but the kind of people that I want to teach are the people who are going to take this knowledge, increase their resources, and then go out and solve some of these huge problems that we're having. And maybe you own your own home or a couple of rental homes, but crossing this ownership to divide in with your investments is critical to getting into that owner class and that true wealth building where you can really make a difference on those people around you. And so let's find out about how Tony is telling us to do it.
Every stock in the world has been beaten by private equity, by average private equity.
So Tony is claiming here that private equity can outperform public markets by kind of a lot. So let's look at his math here.
If you put your money in the S&P 500, it's average 9%. Okay. So if you put $1 million in there, at the end of this time, you'd have 28.6 million. If it's 100,000, it'd be 2.86 million, right? But if you put in average private equity, it's been every stock market in the world, average private equity, not the guys I'm talking about. Yeah. Average private equity is averaged 15.7% per year around the world. 75% higher per year, compounded year after year. Yeah. You put in that same $1 million, instead of 28 million, you have 293 million more. 10x.
Is this math right? Do you really get 10x if you're investing in private equity over public markets? It depends on who you ask. He does have some math and studies to support this from people like Anthony Scaramucci, and there's also math to detract from it with people like author Jeffrey Hook. Scaramucci supports this private kingdom view, stating that markets are shrinking and less companies are going public, Some of them are going private again. It's gone from 7,000 companies to 4,000 in the total stock market, meaning that the most explosive growth now is in the S&P 500 of the top 7 companies. That's not very diversified. Jeff Hook wrote a book claiming just the opposite. It's the nuance here is that he warns that many large cap private equity funds are all smoke and mirrors and they are barely beating the S&P 500 once you subtract the high fees, sometimes up to 3 to 4%. There's also some controversy here with the bad press that private equity is getting with the failure of Red Lobster, Joanne Fabric, some high profile ones going all the way back to the failure of Toys R Us. Private equity just means ownership in companies that are not traded publicly on the exchanges. But the leverage buyout movement, where you buy a company, take out a lot of debt, and then force that company to pay off the debt, is supposed to burn out inefficiencies, but sometimes ran companies into the ground. This leverage buyout movement became kind of the poster child of evil in the 80s and 90s. And what they did is they co-opted the term private equity to redeem them from this leverage buyout thing. So it's important that we don't look at all private equity as this leverage buyout strategy that took Joanne Fabric down, and that we understand that things like our home equity and things like equity in our own businesses that we run is also considered private equity. So Tony is talking about private equity as a whole, which does include companies that do leveraged buyouts, but he's also talking about a wide variety of companies, tech startups, things like this that you can be investing in so you can diversify your public holdings and your private holdings because that helps to hedge. Now, whether or not it actually outperforms or it will continue to outperform, I think that that's less of a point than being diversified across both public companies, 4-ish thousand of them. You have hundreds of thousands of companies that you can invest in privately. And if Tony's numbers are even close to being right, having a 10x improvement of your investments over a 30-year period, the numbers he's using going from 30 million to 300 million, that makes a huge difference. But if you don't have as much money to invest, only a couple hundred thousand or maybe $1 million, that you can go up and 10x that, and that would really make a huge difference in people's lives. That's the kind of money that changes lives, not just your life and your family's life, but your entire community. Even if you don't fully believe the 10x claim that Tony is making, exposure to more companies by investing in private companies alongside your public is just a good diversification play. I personally have private real estate holdings with my partners, with our investors. I hold stock as a limited partner in private companies like tech startups and the boring businesses. And at least for me, my private investing has far outperformed public markets over the last 10 years that we've been getting into this private market side of things. It's a lot more difficult to invest, a lot more paperwork, a lot more due diligence. They're harder to find. But for me, it's definitely been worth it, not only as a limited partner, but also as an owner of these businesses. For me, I'm a big believer in index funds. Total stock market and the S&P 500 have outperformed managed funds for decades. And so I kind of stick my set and forget money into those public funds, but I just don't feel like there are enough companies there to really feel diversified. And so I have a portion of my portfolio that I hold back to invest in private companies because, like I said, for me, they have outperformed, but it's also just a comfort knowing I'm not overexposed to few companies.
The opportunity to grow is insane, but here's the problem. You had to be an accredited investor, which means you got $1 million net worth or qualified purchaser, 5 million. So your young people are going to know, I can't do that. I wrote this book because I found out it just passed 3 weeks ago. The House just passed the new rule. Why should the richest people in the world be the only people that get access to the most effective investments? Don't get me wrong. You you got to diversify, but you got to have a significant port here if you get this kind of 10 times return. They were smart because, like they say, well, you're not sophisticated. Well, some people have $1 million, but they inherited it. They're not sophisticated, or they're a good business person, but they're not a good investor.
Yeah, that is what describes me. I feel like I'm a much better investor than I am an entrepreneur. So he's describing the opposite situation where if people are good at business, then they think that they're going to be good at investing. But it's definitely two different skill sets. And like I said, I think that I excel more on the side of investing. When I run businesses, I can run businesses. My degree's in entrepreneurial management. It's just not something that I feel like my true passion lies. I enjoy business more as a spectator sport, which is why I make a better investor.
3 weeks ago, they passed the law. Now the Senate will pick it up in April. And what it says is, you don't have to be a credit investor to get access anymore. All you got to do is take a test. They're working on what the test is. That's you pay for the test, and now you can put your money and get the same kind of returns to the richest people in the world. And in my case, you can own a piece of those businesses. So when you're going to show business, well, you own business.
What's interesting here is that Alex, who works in private equity as an owner, doesn't know about these securities changes. This bill or a version of this bill has been through the House, I don't know how many times in the last couple of years. It'll pass the House, but then it doesn't get out of the Senate. Eventually, it will be passed by the Senate and signed into law. So we are getting ready for this certified investor exam. But as of right now, this is not a thing, but you do have other options. If you are an unaccredited investor, you can check out Regulation A funds. Those can be publicly advertised and they're accepting funds from both accredited and unaccredited investors, and often with much lower minimums than these funds that are reserved for higher net worth individuals. There's also now something called a Regulation Crowdfund or Reg CF that's open with private companies can put it on a publicly available exchange for both accredited and unaccredited investors. And there's also a growth in investing clubs where larger numbers of people will pool their money so that they can get into an investment together, especially if it has higher minimums and they're able to get into these things because they're pooled. But they also help each other out with due diligence, which is a huge part of investing in private markets. Is being able to get access to information, analyze where you want to put your money, and an investing club can really help you do this. Now, if you are an accredited investor, you do have more options. You can look at a 506c investment. Those can be publicly advertised, but you will need to prove that you're an accredited investor by getting a letter from your CPA. Now, most operators who are offering public 506c investments are also offering private 506b investments, and those are often open to unaccredited investors as well as accredited. Now, in that case, you don't have to prove that you're accredited because they can take up to 35 unaccredited investors. But whether you're accredited or not, to be able to invest in a 506b, you have to have a prior relationship with the sponsor. So it's important when you see an investment, even if you are not qualified to invest in that one, to get on their mailing list and have a conversation with them so that when private investments come out that they're not allowed to talk about publicly, that you have access to that information. So this next clip shows how Tony is talking about what he just mentioned. He can not only invest in those companies, but he can also own a piece of the company as a general partner.
I'm only getting these little slivers. I don't have to change your life, right? I want to get in bigger. And he goes, Tony, I'm going to tell you where I put the majority of my money. This is a very sophisticated investor. And I said, okay, I'm leaning in on this one, right? He goes, off the beaten path that has mastered something unbelievable. He said, you know the difference private equity? I said, of course. He goes, what if instead of buying the fund and fighting to get a small piece, you could own the company that owns all the funds and make the 2 and 20 yourself, side by side with the owners?
Okay, so he is just casually dropping in this 2 and 20 term. We're going to get back to that later, but listen to the next part about who and how he's investing that money so he can collect that 2 and 20.
Do that? He goes, there's only a few companies in the world that do it. These guys are brilliant at what they call general partnership stakes. So you're a limited partner, as you know, if you go in and you got a limited amount, you get in it. Yeah. I said, how do you do that? So I went and met with this guy. Turned out he was a graduate of my programs and 20 years ago, started his business with it. It's called CAS. It's Christopher's Zook. And I talked to Christopher, and so I put some money in with him.
He's just dropping this subtle hint right here about how you can get in on this big fund like Kaz with his buddy Christopher Zook. Okay, let's keep listening to see what other gems he drops. And he just hides in these casual comments.
Next thing I know, I got ownership in Vista. Not, I got a little slice of Vista, right? I'm getting the 2 and 20. So I have 95 of those companies now that I have a piece of. It's it is nothing but a cash machine beyond our wildest dreams. I get to work with the smartest people in the world. They're working all night, and I'm right beside them earning without working all night on those spaces, right?
So this is passive income that he's talking about from a general partnership or a manager stake. So the way that we structure these things is most of them will have a holding company that owns the actual asset and the limited partners will typically have ownership in that holding company. Then you have a management LLC where the people, the executives who are running the actual deal will be the managers of that LLC. Now, the management LLC will collect the 2 and 20 from the holdco. And so they will take 2% of the assets under management fee, usually some annual fee based on how much money is invested, and that will be paid by the holdco into the managing co. And they also get the 80-20 split on the profits. And so if the limited partners in the holdco get 80% of the profits, they'll split 20% of those with the managing co. So that's where the 2 and 20 comes from because they're having 2% fee and 20% of the carried interest, meaning that they got 20% of the profits and the limited partners got 80%. Now, if Tony is invested in both sides of this, maybe he's a limited partner, he puts some money into this holding company and he's actually earning returns on the business or the investment itself, great. But then he has to pay that 20% and he has to pay that 2% over to the owners of the main fund. But because he's also a general partner in the main fund or the managing entity, he also gets to collect that fee and to collect that 20%. So he's able to profit on both sides of this. And Tony mentions that there are just a few companies in the world who do this, but they're not that hard to find. Companies like Blue Owl, and I'm not telling you to invest in them, I don't invest in them, but they have a publicly traded fund buying ownership shares of the management company. And then they also have private funds where they offer the same kind of a structure. So at a conference, if you go to like the Fact Right Due Diligence conference, you will get in for free or low cost if you're an investor. And then these companies pay a fee to be vendors there to be able to present these funds to the people who are at the conference. Most of them are only selling LP shares or limited partner shares, meaning that you don't have any management. It's your money making money. But some of them have a structure where you can actually buy into the management company itself by putting some money in there and investing in that particular business. It's a different business than the one that the LPs are investing in. One is investing in the real estate or whatever it is that they're doing, the company, but then that separate management company is its own thing. Think about it this way. If you own a rental property and you hire a property management company, you are going to benefit by the rents coming in, but you're also paying a fee to that property management company. If you went to that property manager and said, "Hey, I'd like to invest in your company," then you would be getting a profit back from the own fees that you're paying to that property manager. And that's something that a lot of real estate investors do. If they find a great property management company, they will go and invest and partner with that property management company. And this is the same structure that Tony is proposing here. So not only is investing in private equity a great way to diversify, but it's also a way to expand your profits by being able to invest in not only the company that is making the money, but also the management companies running them. And so wealthy people who know people and are able to be organized to take advantage of all of these things are going to be able to outperform what they're doing in public markets typically, where we've seen through the data that it's a set forget type of game over there. But this is more hands-on and it's more driven by who you know, what you know, and taking action and being organized to track it all. And that leads us into the next thing Tony's talking about. It's not enough just to have these kinds of investments. You need to start thinking about your investment portfolio as a business and treating it with the same corporate rigor that you would expect from your own company or any company that you invest with. And most investors are very disorganized and do not treat their wealth management like it is a business, but it is. And so Tony goes on to talk about why that's so important. Let's watch here.
The only challenge with your own business is you and I both know if there's any law of finance that everybody knows, but very few people practice, it's asset allocation, right? You don't put all your eggs in one basket. So most people put all the eggs in their business because they feel more control. And then there's a COVID that happens, right? So you got to be, I always tell people you need two businesses, the one you're in, the one you're building, but also that business plus an investment business where it's growing. So if anything happens here, you're taken care of here. And if they both win, you get there faster than you ever dreamed of. But you got to know where to put your assets. And this is just part of that process. So, but for you, it's like I know what my passion is there. You can feel my passion. I want to tell everybody about it. It's like I don't give a shit about making money. And it's like, and of course I make money too. It's like it's unbelievable.
So now he's back to talking to Alex about passion, but you could see his passion for this private market thing. That's more where I fall in line with what Tony is talking about in that section. I got very excited. I started pausing and I'm starting to tell my husband, "Hey, come and listen to this." He's talking about what we've done, what we do for a living now, managing our investment company like a business, and that we are passionate to share that message with other people. So what kinds of things are you maybe not doing in your own investment business that you should be doing and maybe in your other business you are doing or the company that you work for is doing, but you're not? You must run your investments as a professional business, and that means having a dedicated LLC, maybe more than one, a family trust, maybe a family lending bank, professional bookkeeping, tax preparation, maybe a wealth manager or financial planner. There are so many tools that you can take access to and use with corporate rigor inside of your own business. Now, I can't afford a dedicated team like a family office would have where these are all in-house and they only work for me, but I can use the pattern that they've set up and the companies that I invest in and watch how they do it and copy that into my own business by using fractional providers. So having a team of advisors is not a way for you to abdicate responsibility. You are the CEO of your own family wealth and you need to treat it like a business. We know that wealthy people are organized. And organization is another tool, like Tony said, of diversification, knowing that you have these businesses that you're running well. If they both do well, great. But if one doesn't do well and the other does, you always have those hedging against each other for an active business and a passive business to be diversified and hedging against one another. So, what do we learn from this video other than how to find joy, which is where everybody else is focusing? We learned on how access is opening up for people to be able to get into more private market investing and that you also need to be able to run that private market investing business like an actual business with the tools that you need to do that. We're going to copy how the 1% does this, and we're going to use it the same way that home ownership changed two generations of family wealth by being able to own a home and enjoy the growth of the equity of that home as inflation goes up. It's the homeowner's friend. But we're now seeing that increased access into business ownership, not only through private market investing and opening up those regulations, but we also have some technology on the horizon like tokenization that allow people to take advantage of business ownership in private companies in a way we've never been able to before. And this is the next frontier of building wealth and protecting wealth. And I sure hope that you're along for the ride for it. If you want to get a hold of me to talk about investing or organization tools, you can get a hold of me easily at investwithemma.com, and be sure to hit the like button to show me that you are an owner or you're thinking like an owner.